So the result for the half year to 31 December 2012, I think, is a pretty pleasing one, all things considered, where we've produced distribution growth of 7.2% over the comparable period to December 2011. Slightly better and ahead of guidance. At the end of the last financial year, we guided the market for growth rates in the low sixes. So, as I said, pleasing to come out with numbers in excess of that. The main contributors to that financial result, firstly, the South African portfolio, which is made up of retail, office and industrial. Pretty solid performance there with like-for-like net property income growth in the order of about 7.6%. Particularly good showing, I think, from the retail portfolio and the industrial portfolio, with slightly lesser contribution from the office portfolio. No doubt that in terms of the fundamentals, the market fundamentals, the office sector is still the sector that is lagging the other two, with vacancies being significantly higher than the vacancies in the other two sectors. And even if you look at some of the other dynamics, such as renewal rate on leases and rental growth on renewal of leases, office sector clearly lagging the other two. All things considered, though, a pretty good, robust performance from a very well diversified portfolio in the South African business. On the property fundamentals in South Africa, overall vacancies at 4.1%, marginally above the comparable period at 4%. Still, I think, very acceptable levels. Our total arrears at 48 million, down from the comparable period, and showing, I guess, that the overall position of our clients and our tenants who are paying our rent, that they are all in good financial health. And also very important is the costs and the fact that we believe we've got a handle on costs. Our cost to income ratio in the South African business staying at below the 24% level. Next contributor to the results is the V&A waterfront. Pretty solid showing from the waterfront, with 7% growth in distributions and contribution from the waterfront. Again, clearly a very mixed portfolio: retail, hotel, offices, marina, etc. Very much in line with our original expectations when we made the investment. I believe the hotel sector has bottomed out, but retail in particular showing some very good growth. Current turnover, 12-month rolling turnover growth at the waterfront in excess of 18%, which is well above the national averages of probably closer to 7 to 8%. And then lastly, Growthpoint Australia, another very good showing from Growthpoint Australia, very much in line with the forecast which we gave the market about 6 months ago, projecting to deliver 18.3 cents of distributable income for the full year. A slight but a slight negative impact of the introduction of some taxations and withholding tax on our distribution, which affected the dollar quantum of revenue that we got from Australia, but more than offset by a significant weakening in the rand against the Australian dollar. So on a like-for-like basis, we achieved over 12% growth in distributions from the Australian subsidiary, clearly very enhancing to the overall business.